I'm Greg Brogger, CEO at Collective Liquidity. We're going to be presenting today the next in our series we call the Insight series, in which we try and provide our members and our audience with some unique insight and information, and maybe a fresh look at some of the key topics in the private market and late stage venture investing. And primarily, this presentation is going to be done by our Chief Investment Officer, Ankit Misra. Ankit, why don't you take it away?
Awesome. So I think, first of all, glad to be back in front of you all. I think it's been a year with a lot of sort of developments impacting private markets, be it AI, be it regulatory landscape. But I think the topic for today's discussion, we centered around, how does private market opportunities contrast with public equities, and specifically, looking at how much is the proliferation of private companies and what characteristics they have vis-a-vis public ones, and what does it mean for investors from a value creation and return potential perspective. And then quickly sort of also touch base on the current state of public equities and private markets in terms of their valuations and attractiveness of the entry point today, and also touch upon some of the recent private market trends. So that's the scope of the presentation.
Yeah.
Then sort of diving deeper into the first topic of, what are the characteristics of private companies, and, what's been the relative market size, if you may. This is a chart that we use a lot with our investor base to sort of surface the importance and abundance of private companies vis-a-vis public ones. And 2 points that we'll make here and in the following chart and then on this chart is centered around just the share of wallet and the growth potential. And by the share of wallet, what I mean is that private market has a far greater universe of companies than public market. And what you see here on the left chart is the number of private company unicorns that were there 10 years ago versus now. And there's like a 20x increase in that.
Yeah, no, I just want to echo. It's an amazing development. So the team at Collective has sort of a long history in the private markets, going back to 2009 with the first handful of unicorns. So Facebook, LinkedIn, Twitter, these were the first unicorns. And so I think, many people had, just discussed the trend, the shift for companies to go public much later in their life. But I don't think a decade ago people quite realized the sea change that was happening. I mean, this is a, fully, call it a tectonic shift in the way the capital markets are structured. And so we're seeing the results of that, but it is sort of startling to see it happen in these kind of numbers over that time frame.
Yeah, and in contrast, the number of public companies has been shrinking. And so 10 years ago, there were probably 8,000 plus publicly listed companies, and today there are about 4,000. So it's very contrasting that the relative ratio of private companies to public companies is, as we stand today, about 85% plus of all the companies with 100 million plus revenue are private. And that has implications on, investors and, just the innovation economy and whatnot. But, I think it's important to, gauge at this page and, wonder about, like, why is this happening and what are the consequences? And in terms of why this is happening, I think the natural question is, like, why are more companies staying private at scale, right? Is it by choice or is it by constraint? And while some of it is to do with just the reporting and operational burden of being a public company, I think many companies like Stripe or SpaceX just don't feel the need to go IPO. It's not a goal for them.
Well, and I think some part of what used to drive private companies to go public much earlier was the lack of capital, growth capital, or capital for the kinds of companies they were growing into in the private market. But over the last decade, due to a bunch of different factors, there's now abundant capitals, right? So the need, at least to get primary capital into the company, doesn't require an IPO anymore. As exactly as you said, companies like Stripe and SpaceX have shown sort of sustained ability to raise billions of dollars if necessary to fund growth. And so if the public market, loses that advantage, then the things like the regulatory overhead and the reporting requirements and the volatility of trading in the public markets, those are not attractive to founder CEOs of high growth companies. And if they can get the capital in the private market, it's, it's not a mystery as to why they would stay private.
And then the other aspect of it is, if it's happening, then what are the consequences? And I think there's an increasing degree of customer awareness and regulatory acceptance of private markets. And like traditionally, you'll have like a 80-20 stock and bond investor, and they would not have access to private investment opportunities. But now several platforms are focused on providing direct access to private markets. And Collective obviously being one of them in its own unique way. But that's clearly a trend. The other one is also like emergence of crossover investors who were previously focused on public markets alone and are now trying to capture companies in their private stage, catch them early and ride on that growth that we'll see later in the webinar is increasingly scarce in the public markets. And lastly, also from a regulatory perspective, obviously hurdles to be an investor in private companies have been going down, and then most recently, like even 401ks are now being open to alternative investments, and that I think will just unlock a lot of sort of exposure to this asset class, which rightfully it should be easy to access because it creates wealth for everyone through its growth trajectory, and that's something which is being increasingly hard to achieve in the public markets.
Yeah, when people ask, at least me, about whether we see this trend continuing, it is sort of a self-reinforcing cycle. The more openness there is to different kinds of investors to private market investment opportunities, the more capital is available to these companies, and again, the less reason they have to go public. And I don't see much effort in the legislature or with the regulators to make being a public company easier. I mean, it's talked about from time to time, but I'm not aware of any like serious effort to really lighten the load or change some of the structural things that entrepreneurs and high growth companies find unattractive about the public market. So I wonder what this chart will look like 10 years from now. It could be equally dramatic. I mean, you wonder what happens to the public markets if they lose another 50% of their companies. Does that change not just the appeal of being public markets, but just the fundamental nature of the way capital is deployed and invested across the US economy?
And I think that's a good point, like that one is just the number of companies that are public, but also what's been the quality and growth profile of the companies that's public.
Yeah.
And that's what we see in the next chart, which was very interesting trend, first sort of like brought into limelight by Cotu. So, we really like the insight that was shared there, that if you look at the last, call it 4 to 5 years, and look at the growth rate of a typical publicly listed company, and it has gone down from highs of more than 25% to 5%, and also like another way to look at it could be the percentage of these companies which are growing more than 25%, which is the kind of growth that you want to see as an investor, and that percentile has sort of dropped from being 17% to now less than 10% at 9. So, and then that's like vis-a-vis, if you are a private market investor, you routinely see opportunities in 30 to 40% revenue growth in late stage VC world. So there's definitely a sharp sort of gap between public and private companies.
Well, it seems like what this really makes clear is that at the very least, in the minds of the entrepreneurs, the founders, the CEOs of the high growth, particularly, that obviously overlaps a great deal with tech. Tech entrepreneurs look at the public markets as inhospitable to high growth companies, right? So the high growth companies are, I mean, the dominant strategy seems to be don't go public when you're in your phase of high growth. If you're generating returns of 35, 40% or more, there are a variety of aspects to the public markets that make it very difficult to manage as a public company with that kind of growth. And so this chart makes a great deal of sense to me.
And I think it's probably more correlation than causation. I don't think so. Just the fact that you are a public company makes it harder for you to grow, notwithstanding all the burdens that we talked about from an administrative perspective.
Right.
But I think the key driver of that is it's harder to grow when you're big, right?
Yeah.
It's a lot easier to go from 1 billion to 10 billion than to go from 1 trillion to 10 trillion, right? So naturally, you'll see some diminishing returns on growth the bigger the companies are. And the threshold for companies going public has significantly increased from being about $100 million, call it 5 to 7 years ago, to now like average, revenue of the company going IPO this year was like 5 to 600 million.
Yeah. Well, I think maybe it's a combination, meaning the public markets are getting starved of high growth companies because high growth companies are staying private. And the companies that are already public are older and older and therefore less and less likely to be delivering the kind of high growth that you see in the private market. And so between those two factors, no new high growth companies and the existing companies' growth slowing, that makes that just decline from 17% to 9% clear, or I think explains it.
Exactly. So from a private company perspective, basically there are many more of those out there, and they grow much faster. Was our two sort of key takeaways. Then we also wanted to look at what does these private companies mean from an investor return perspective. And we did some work. Our research team sort of went back and looked at all the successful sort of tech and innovation oriented companies, and looked at their history of private market fundraising, IPO, and evolution of sort of publicly listed share price, and then try to gauge from it how much of the value creation was captured by private markets versus how much was available for public market investors as well. So the blue bars here is the share of value created that was captured by private markets, and on the left side you'll see that historic companies that went public early, and they were important source of returns for public investors because they were available, and it created sort of many individual millionaires or institutional sort of funds benefited from it. But in the contrast, like if you see on the far right, you'll see many companies that have chosen to stay private and are thereby by definition inaccessible to public investors. And these could be of like two types, where there are certain companies for whom IPO is not a goal. Like I would place SpaceX and Stripe in that category, and there are many others which basically have not embraced IPO as a priority, but they would be open to it if the market have good conditions, and that's where Databricks or Revolut may fall. And then in the middle you see several companies wherein private market investor captured majority of the value. Mm-hmm. And it was very telling for us to look at this and sort of makes a very strong case to not ignore private markets. Having said that, like each company has its own story and its own trajectory, so it is hard to generalize. But I think one thing is clear, that if an investor is solely focused on public markets, then one is leaving a lot of return potential on the table.
Well, I think if you want growth companies, right, I think that this is about even clearer, right? So it's not just private market returns, but if so much of the venture world is driven by some number of standout home run 100x type returns, and there's a list of them here, and they drive an enormous amount or really significant percentage of the total returns across venture. And so if you want to capture one of those in your portfolio, this seems to suggest, particularly over the last couple, 3, 4 years, you really need to be participating in the private market side because again, the dominant strategy seems to be stay private as long as you're in a high growth phase. And this just seems like another angle to look at that, what that means to investors.
Yeah. And I think then we also looked at the same set of companies and looked at the IRRs that the investors had realized in different phases. Because even with companies like Google and Facebook, where these blue bars are pretty de minimis, that's because they have been public for a very long time.
Mhm.
And that's akin to basically what cash on cash returns you're making. But what does it look like on an IRR basis is even more interesting, because even
Mhm.
for those early stage companies, private market investors made much more IRR than public market investors, and which shouldn't be surprising, because I think underpinning these investor returns is basically the revenue growth of the companies. And if you aggregate across all these tech companies, average for public market investor was 30%, the average for private market investor was 82%. So companies delivered more than 3 times IRR to private investors than to public investors, and which it also speaks to why one should consider private market investments.
Mhm.
Okay, so with that, I think we wanted to look at the current state of the market, how the valuations are holding up in public equities and private markets, because I think in addition to growth, the entry point valuation also matters, because if you overpaid and came in at 20, 40, 100 times revenue multiples, not many companies could grow enough to grow into the valuation. So it's really important to understand where in the valuation cycles you are for a particular market. And looking more closely at public equities, I think it's actually a very easy observation, and a lot of research houses have been pointing it out for some time, that the concentration in S&P 500 is at record high. Like if you look at the market cap of the top 10 stocks vis-a-vis S&P 500 altogether, it's the top 10 stock constitute 41% of the market today.
Well, and that's
Sorry,
on roughly 4,000 public companies. So out of 4,000 public companies, 10 of them are
500.
500.
This is,
Okay, sorry,
yeah,
the S&P 500. Okay. That would have been a startling number, but still, yeah, that 10 out of 500 represent 41% of the total market cap is um, startling.
yeah. And I think notably, this concentration is not commensurate with earning distribution, because if those same 10 companies constituted 40% of the earnings, like it's fine. Then you're saying that you have had few very successful companies. I think um, it's it's a little bit more concerning to look at this concentration in the context of that it's really driven by multiple expansion of these top 10 companies as opposed to earning expansion. And then that's where,
Yeah, I was
yeah,
just going to ask, is that driven by a perception that it's only these 10 companies that have the growth rates that justify the higher multiples, and the rest of the S&P doesn't? Meaning if you're a public market investor or limited to public market investments for your equity portfolio, your choices for where high growth companies might be, and obviously AI has got to be a significant factor over the last couple of years, you're really limited to these 10 companies. And so that obviously, as people pile into those stocks where they see growth, that drives the multiple for the market overall.
yeah. No, so that's a great question, and I also wanted to cover the valuation piece, but given that you raised it, when you look at this concentration, there is some analogy in the past around what happened around the 2000s time frame, where you had the last set of next big technology wave coming through .com, and you had the infrastructure providers being the leading sort of winners in that in the early innings. And then once that infrastructure was out there and ready to be used by the broader market, people who were then adopting that infrastructure of internet and cloud benefited from it. So from a concentration perspective, one could argue that today when we talk about a lot of AI adoption, it's really been driven by very bottom of the stack companies, right? Chip manufacturers, large LLM model sort of providers, data centers. And once all that infrastructure is there, you would expect, I think, more broadening, similar to what you saw historically, right? So in the run-up of a new technology finding its footing, you see a lot of people who are actually doing the nut and bolts of that technology infrastructure be the winners. And then once that technology is embraced and you see broader businesses adopting that technology and benefiting from it, emerge out as equal winners in the long term. So I think there's this thesis around that right now concentrations are high because you have these companies which are very tech forward and enabled by AI, and they're building the next generation infrastructure, and it is driven by anticipated growth. But then the markets are expected to broaden as the eventual AI adoption is done by businesses which own the data and they benefit from it and own the customer relationships.
So their productivity will be increased, not yet, but in the near future, and that should result in revenue and therefore ultimately market cap. Yeah, interesting.
The other aspect, sorry.
I was just saying,
and the other aspect of where are we in the public equity cycle is just around the PE multiples. And if you look at the right-hand chart here, we are definitely at the top decile of PE multiples that we have historically seen in S&P 500. And if history is any indication of the future, whenever the market has been at these high multiples, it has produced flat or very modest returns in the subsequent 10 years. So, the outlook for public equities, notwithstanding all the AI optimism, it's actually very richly priced today, and arguing for the historical, call it 8 to 12% average returns of public equities could be tested just because of the multiples that you may have to pay to get in today in public equities.
Yeah, it's rare that you see such a tightly drawn sort of clustering of the data along a particular line. And here that just given this is over what type of time frame that you've collected this data?
It's very long term. I forget, it's probably 30 or 40 years. So it's very long term data.
Yeah, that's
across market cycles and across sort of recession cycles and whatnot.
Yeah, it's making me feel uncomfortable about my public equities holdings just looking at it. So that is interesting.
And then in contrast, I think the private market multiples have definitely corrected, and they have gone a mean reversion from the peaks of 2020, 2021, when the round were getting done in weeks and without limited, any material due diligence. And so that phase is definitely gone, and there's been more sanity in the private markets, and the multiples have reverted to their historical averages. So you see, like in this chart on the left, that the average multiple was called 16 times in 2021. It's now close to 8 times, and there's still premium for growth. So companies that are growing more than 30% are raising money at 7 to 10 times, even more. And the low growth companies, less than 15% of revenue growth, are more like 4 to 6 times. And those are, I think, much more reasonable multiples to come in and then ride on the growth.
Well, and Ankit, how do you think about just the comparison between the multiples that we saw on the previous slide at 20x and the multiples that we're seeing in the private market at 7 to 8x? I mean,
Well, so
is
they're
that
not
just
like to like.
or
Sorry,
sorry, go
they're
ahead.
not like to like in the sense that on the prior page when we saw PE multiples, those are earning multiples, and that's how
Mhm,
public equities trade. They are usually profitable companies, and they are looking at earnings as the key driver for market price. Whereas in sort of private markets, especially call it medium stage and even late stage, companies have some profitability, but not enough
mhm,
to be able to um, to be able to reach a point where they are able to use P multiple.
mhm,
I think that's another aspect which needs to be kept in mind, that not all growth is equal when we're talking about public company growth.
mhm,
That's well established profitable growth
mhm,
versus private markets. I think there's now more focus on growth balanced with profitability, and that's also what, like, when we are evaluating companies, we constantly think about. In fact, like at Collective, when we're focused on investments, those are mostly profitable companies or companies which have imminent path to profitability, as
mhm.
opposed to a 2020 and 2021 era of growth at all costs.
Yeah. Well, and that seems like a natural and usual part of the kind of venture market cycle, as it the pendulum swings, the focus on profitability and fiscal discipline, controlling expenses is naturally what you would expect at the bottom of the market, and then as it starts to accelerate again, and people get excited, and more capital and more investors come in, things get bid up, and there's less attention spent on profitability and more on just revenue, top line growth.
But I think in general, like private market valuations, I think have, as I said, reverted to historical averages, and compared to public equities, more moderately priced. Having said that, there's still things to be washed out in private markets. I think while the headline valuation has normalized, I think there's increasing prevalence of structure in the financings, and you need to watch out for things like liquidation preference, cumulative dividends, and all those things are tools that sophisticated investors use to extract economics outside of their fully diluted ownership implied by the headline valuation. And again, tying it back to, it's more Greg, your leadership, that collective valuation stack that was developed
Hmm.
analyzes cap tables and waterfalls and these unusual sort of structures, and sort of and the impact it has on the common equity value versus the last round preferred headline valuation.
Well, and I just forgive me for going back to the prior chart, but I just one of the things that occurred to me is just the impact AI has on that 7.9. And so I wonder if you removed the relatively small number, growing fast, but relatively small number of AI companies from this data set, that multiple would probably be significantly lower. And if you expect, and it seems like I've read at least a few commentators thinking that the AI valuations might start to come down as people look for real business models and real revenue rather than just the promise of the technology. It's interesting to see where this number goes in 2025 and 2026.
And absolutely, there's been definitely that almost tale of two cities within the private markets world. AI companies doing a lot easier to raise. I mean, there were 15 companies that we took to our investment committee in the last 12 months, which were founded less than 2 years ago and raising unicorn at Series A stage.
Yeah.
Um, as much as I'm appealed by the problem that they're trying to solve, I think it's incredibly hard to underwrite it from an investment perspective, because not all of them will grow enough into the market to justify those
Yeah.
multiples.
Well, it seems your focus has been, or Collective's investment focus and strategy has been to participate in AI more through the infrastructure play, than the kind of raw tech was essentially research and development type products that are pre-revenue, which I think is certainly a safer way to play that market.
Okay, and then with that, the last section was really around sharing some of our insights that we see on our platform around private markets particularly. And this is information that's coming from our proprietary platform, which sort of takes in underlying data from all private markets platform that have secondary activity. And in general, volumes are holding up well. The bid offer spreads are tightening, which is an indicator of healthy liquidity in the market. And also like the discounts, which were, I think, a big concern, like coming out of 2021 and 2022 on how to price companies in 2023, because Common was priced at often more than 50% discount to last round because investors overpaid, and it was really hard to ascribe or reset that valuation. But as companies have fresher round of financings and secondary activity happens in the back of those new financings, you see more tighter bid offer spread and convergence in those common and preferred valuations. And that's, I think, good for long-term health of the market, because otherwise, if there's just too much bid offer spread, then there are no trades. There are sellers who want unreasonably high prices, or there are buyers who are looking for bottom fishing and trying to establish a too good deal for themselves. And whereas we think that there should be just an infrastructure where you get a fair price based on where the markets are.
Yeah, I think this data seems to pretty clearly reflect that we're no longer in a distressed market environment for private market sellers, which is certainly encouraging for, as you say, the health of the market generally. But I think as we see the chart on the far right, as the buyers appear to be paying a premium over the last round price at this point, there is sort of widespread confidence in the market, if not in the market, at least in particular private companies that people are investing in, that the benchmarks of the 2021 valuations and the rounds that got closed during that period of irrational exuberance and historically huge multiples, is starting to be in people's rearview mirror, and it's going back to much more, call it, normal market conditions, which, as I said, is I think quite encouraging for private market investors and private market sellers as well.
The other point I think we should cover is that the liquidity is not just improving in the secondary markets, which I think is a good development, which, to Greg's prior point, has actually been one of the reasons why companies are comfortable staying private for longer. But even outside of secondary markets, the IPO window is definitely steadily sort of improving and opening to the levels of almost pre-pandemic days. So this is the first half of 2025 vis-a-vis pretty tough, like 22, 23, and 24. But looks like 2025 may meet or even exceed the pre-pandemic levels, and that would be a good milestone. And we've had some really good sort of companies coming back to the IPO markets in the first half of this year, and that's very encouraging to see.
Do you have a view, Ankit, on what the second half will look like? Obviously, we're just coming out of the summer, a traditionally very quiet period, and issuers thinking about kind of late September, early October as the window to get out if they're going to do their IPO in 2025. Does the pipeline look strong?
Yeah, no, I think the reported pipeline is strong. And we can vouch for two of our portfolio companies also in the queue for data this year. And now it may spill into, instead of being October or November, it may become January or February. But there's definitely optimism in the sort of management teams and the bankers, and everyone is definitely looking at this opportunity, and especially in certain sectors like fintech has done really well. Even digital health has caught up. Obviously, AI and all the data infrastructure space continues to be very hot. Crypto has also gained up. We have, I think we have a chart talking about sectors in a bit, but
Well,
I think
and
pipeline is strong.
do you think AI companies, given how young they are relative to, others that have historically gone public, will they move into the public markets, or do they will they face the kind of scrutiny in the public markets and the demand for actual performance that the companies that are likely to go public in the next, call it year or two, are going to be not AI companies or not as much AI companies, but more traditional software companies and fintech companies and that the like.
Yeah. I think the financial profile of these AI companies, including the big ones, be it XAI, OpenAI, Figure AI, like I think they have pretty healthy valuations, but not really the financial profile to be
Although,
hitting the IPO markets yet. So they really have to prove out that they could really establish like really big businesses, and it may happen pretty fast. I mean, that's one thing to watch out with AI, that the pace of innovation and the pace of change could just take everyone by surprise. But I don't think so they're there yet.
yeah, I think as you said, if the threshold is five or $600 million in revenue, there's relatively few AI companies that meet that requirement.
Well, and it's not just revenue, right? Like, do you are you profitable? If so, what are your margins? Like,
Yeah.
how far are we from a point where AI companies can be valued based on whatever, even 20 times PE multiple? Like, most of them don't have net earnings right now. So, I think there's still a couple of years at least for them to grow, not just their top line, but also, show profitable growth. But there's definitely one thing which is a huge tailwind for them, which is big addressable market for them, right? So I think that's what people are buying into and are betting on. But right now, like with a lot of public market focused mutual funds, sign up during the IPO process to take subscriptions, probably not.
Yeah.
And then, so outside of secondaries and IPO, the other form of liquidity is through M&A, and that also is really encouraging to see that you know, 2025 so far has been pretty amazing, and
Mhm.
the M&A volume is outpacing the 2021 levels, and there have been some mega deals like Google's acquisition of Wiz, or in general, like also the sentiment because of more conducive regulatory environment, and some of it is also just driven by arms race for AI, like the OpenAI acquisitions, or Meta acquiring some stake in Scale AI and Acquihire there.
Mhm.
So across all of this, I think M&A would also serve as very important channel of liquidity, which I think is if you think about what is needed for private markets to thrive, I think they intrinsically have the growth advantage, and if you stay in from those companies for long enough, and then you have exit liquidity, and
Mhm.
you have not overpaid and you're disciplined, like those are the constituents, right? Like the superior growth, enter at the right point, path to liquidity. I think those are the key concerns for private investors like us.
Agree.
Okay, and we briefly wanted to touch upon how the private market performance has been by sector, and I think many of you are already close to it, but aerospace and defense has been the most resilient sector in the past 3 years. And AI has obviously caught up more recently, but more like in the last 18 months or so. And fintech also is emerging, especially with the recent wave of IPOs, and some of them have been down round vis-a-vis their last round of fundraising, like Chime. But in general, there's more fintech sort of IPO appetite, which I think is going to be really helpful for this sector in the long term.
It's interesting to see if you think about just looking at the crypto and blockchain, the little, rather sharp uptick. I take it as probably reflected or driven by the kind of regulatory change brought in by the new administration. You see the impact that that has had. And similarly, the aerospace and defense also driven by, you know, political decisions or geopolitical events. These are things that are, I mean, you don't typically think of them as driving technology markets, but clearly they do.
Okay, and then the last point we wanted to touch upon is I think is a very subtle point around thinking about what's a good way to take exposure to private companies, and you know there's a traditional way of getting exposure through vintage drawdown funds where you have these leading VCs who have decades of track record, um, and then that closed fund sort of architecture. And then, more recently, you have started to see in the market, including Collective, embracing evergreen funds, which I think has very distinctive advantage of um, basically maximizing your time spent in the market. Um, because with sort of closed-ended structures, you got to commit capital. And then when funds claim that they're generating 25% IRR, they start the clock when they draw your money, not when you give them the commitment. And that introduces performance drag in the calculations. And PitchBook did this very interesting analysis where a fund generating 20% IRR, but because of the effects of uncalled capital commitment and unexpected distributions, it's almost equivalent to an evergreen fund returning 10% GWR. So the drag from uncalled capital could be significant, and which is leading to benefits of people embracing open-end funds in the especially in the late stage venture space, and that's a trend which I think is here to stay.
Yeah, it suggests that all of the historical IRR numbers that we get from Cambridge and Associates and other, and the NVCA, right? Those numbers really represent the returns if you were direct investors in the companies rather than direct investors in the funds because of the uncalled capital, obviously, and then the fees that are layered on top. But yeah, that you would have to do twice as well in a traditional vintage capital call type venture fund structure. You'd have to do twice as well there as you do in an evergreen fund because of the performance drag of the money that's sitting on the sidelines while you're waiting for it to be called. Interesting. Well, I think, Ankit, we're just about literally a minute from having to conclude. Any last thoughts? It was really, I thought, some eye-opening data that I had not seen, and I think really strongly makes the case for private market investments and a concern, frankly, for public market equities. And suggests to me that there's a real argument for rotating out of public equities and into the private market. As self-serving as that may seem, I think that's what the data supports. But anyway,
Exactly. I think, yeah, I would say exactly that. Like, exposure to growth companies is a great source of returns. And so allocate to private growth companies and hold them for long term so that their revenue growth can translate into equity value for investors. And I'm a little old school in the sense that I like to maximize my time invested in market versus optimizing market timing. So that's why this chart is also very near and dear to me. I think the structure allows us to like instantaneously get exposure to the underlying portfolio companies, and that compounding is really important.
okay. Well, maybe we'll leave it there. Or any last words, Ankit?
No, I think that was great, and as before, like feel free to sort of provide feedback and the kind of content that you would want to see from us, so that we can tailor our future webinars according to that.
Sounds good. Thanks everyone for attending. Be back to you soon. Bye.